major changes to the U.S. tax code, which have recently passed the House and are now pending in the Senate as the Build Back Better Act. I'm Fred Tannenbaum, partner at Gould & Ratner in Chicago and first vice president of the American Israel Chamber of Commerce. We're looking forward to an enlightening discussion about this critical piece of legislation, which potentially affects all of us personally and our businesses. As you probably know, the mission of the AICC is to burnish commercial ties between the U.S. and Israel. Therefore, nothing is more relevant in understanding business activity than the U.S. tax code and its impact on business and personal activity, both domestically and internationally. If ever a subject like tax could actually be considered electrifying, it's now. We'll soon learn just how much is at stake and possible approaches to mitigate some of the impact. I first want to thank the AICC and its president, Scott Glickson, and executive director, Michael Schmidt, for their help in putting this webinar together. I'd also like to thank my co-hosts, Louis Marver from William Blair and Rob Eisenstadt of KRD Ltd for their invaluable help in organizing this event. So our format today will allocate 10 to 15 minutes each to our speakers, and then we'll turn it over to all of you for Q&A. We should be able to wrap this up by 1:15 or so. If you have a question, please either email it to me at ftannenbaum@gouldratner.com, or there's a chat function on your screen, and just type in a question, and we'll be sure to get it heard. So I'm really delighted to present our first speaker, Chris Brathwaite. Chris is a partner at William Blair here in Chicago. Chris works extensively with wealthy families, business owners, high net worth individuals, and corporate executives. Chris focuses on their wealth transfer planning and liquidity events, as well as overall tax sensitivity. We thought Chris would be perfect to kick off this panel, as he'll shed light on considerations that business owners and wealthy families will have to be sensitive to and navigate the House bill is ultimately enacted. So Chris, please take it away.
Thank you, Fred. I appreciate that great introduction. And you used a word or a term just now that I think exemplifies a lot of 2021, which is electrifying. I would say that the M&A activity and certainly what we have seen relative to business owners and private company transactions has been certainly electrifying. And today we're going to begin this discussion speaking a little bit about how this potential shift in the tax landscape actually affects business owners and some of the typical considerations we think about ahead of a transaction. As you know, William Blair is very active in the M&A advisory space, specifically the sell-side M&A activity. And one of the areas that I focus on is providing business owners with guidance ahead of a liquidity event. So we're going to kind of talk through a little bit about that process of looking through the transaction. When we're engaging with a business owner or a private company, management team, or a team of shareholders, we're thinking about the transaction as not only an event to monetize the business, but from a personal dimension, we think about pre-transition, what considerations does that owner need to think about relative to their estate structure, even topics such as asset protection, maybe thinking ahead post-transaction to shifting from a private illiquid stock situation to turning that now liquid balance sheet into a sustainable paycheck and recreating that income stream. So that's typically our process, and we have over the years created a wonderful checklist of areas that we work through on behalf of those business owners. My dear colleague Jessica McCann and I worked on putting together a checklist almost 10 years ago, and this is a bit of an eye chart for a Zoom discussion, but it gives you a sense of some of the key core planning areas that we walk through from liquidity and cash flow planning, wealth transfer objectives, risk management, and then ultimately investment planning. Why does a shifting tax landscape impact us, or really think about disrupting what we have done, is kind of where we're getting into. Because before we can advise a client to consider an irrevocable transfer to the next generation, for example, we really want to understand where their core capital will be post-transaction, post a liquidity event, and really make sure that we've done some financial modeling to satisfy what we consider the bottom of this chart, which is the core capital, lifestyle spending, as well as some buffer or some personal reserves for near-term or unexpected financial needs. Only then do we start thinking then of these other aspirational areas, such as shifting wealth to the next generation, maybe philanthropic endeavors, or discretionary items like purchasing another home or vacation property. All of that is definitely predicated on our assumptions long term. So when we talk about a shift potentially of capital gains rates going from what we have today as a long-term rate of 20% to what was discussed not so far ago, shifting up to close to 40%, that would clearly have a long-term impact on our ability to advise a client to have an irrevocable transfer. This case study here exemplifies why the planning is so important for these situations when we have a founder or a shareholder group that's going through a transaction. If we can really plan for ahead of the event and think about effective transfers for the benefit of the next generation, but maybe even also some charitable giving to reduce the income tax burden around the year of the transaction, there are opportunities to make some substantial income tax and estate tax savings. But all of this is predicated on what my colleagues are going to get deeper into, which are the estate tax exemption amounts, the treatment of retirement income, and certainly estate tax rates, and also exemption levels. So without giving away too much, I wanted to give you a historical sense, and this chart kind of goes back all the way to 1916, and it shows not only the estate tax rates, which you see have definitely fluctuated over time and trended upward at points, but also the exemption level. So right now we're at a 40% rate. I don't believe you can see my cursor, but you can see on the far right, we're at a 40% federal estate tax rate. And the exemption level is at a historical high. So one of the key provisions being considered for the chopping block was that exemption level, and how much you could shield from federal estate tax has been bantered around, and that's one of the key considerations. And why that's important in these events is because it can certainly lead to thinking about strategies that play well for high exemption levels. Right now, we're at an $11.7 million per individual. So a married couple can shield over $23 million from federal estate tax. But it's in current law slated to revert back to inflation-adjusted $5 million in 2026. And this is an area that we're watching closely. And it's also an area which has led to some planning considerations, which we'll touch upon as well. Similarly, interest rates are key assumptions for our long-term planning. And as you can see from this chart, the historical interest rate levels have drifted downward over the past several decades to really record low rates. This This chart tracks both the AFR rates, applicable federal rates, as well as the Section 7520 rates, which are the rates tied to many of the wealth transfer tools we would consider using. And you can see it's trended downwards dramatically over the last multiple decades. Wealth transfer strategies that play well with this kind of interest rate environment, like GRATs or interfamily loans, is also an area that would be a very good tool to use in this environment, and also an area under a lot of scrutiny and debate in the current tax environment. And as I mentioned, spousal lifetime access trusts are an example of a wealth transfer technique that would benefit from high exemption amounts. So many of you have maybe connected with your own personal estate planning attorneys or worked with advisors to discuss whether or not taking advantage of these high exemption levels in 2021 is a prudent step to take. All of that is kind of up for discussion as well. So this is kind of the backdrop for what is being debated. I would also add in here a couple of other key areas that we're watching. One is qualified small business stock exemption, which is one of, in my opinion, one of the most potent tools that small business owners can use to shield an appreciation from capital gains tax. We're also looking from a financial sponsor perspective of those who hold private equity interests, the treatment of carried interests as an area to watch closely. And then finally, the other key area that we're watching is the charitable space. So the treatment of qualified charitable deductions, AGI exclusion amounts for donor advised funds and private foundations, the ability to take discounts also for wealth transfer areas. Those are all areas that we're watching closely relative to how the coming tax regime could affect planning for business owners around liquidity events. So I will conclude my remarks there and hand it over to my colleague Howard to get into some of the specifics. But I wanted to frame up our discussion with that backdrop of why and why it's important to think about all of these changes in the context of the entrepreneurs and business owners, and many of whom are on this call.
Great. Thanks very much, Chris. Really appreciate your presentation. And it teed up some really important changes brewing in the income tax and retirement benefit laws. You talked a nice snapshot about what's going on today and whetted our appetite for how these changes might impact family businesses and overall planning. So it's a great segue to our next speaker, who you just mentioned, Howard Backrens. Howard's the Director of Tax Planning at KRD Ltd. Howard concentrates on income tax and business planning for closely held mid-market businesses and their owners. Among Howard's other areas of tax focus, he's an expert at tax planning and mergers and acquisitions and family estate planning. Howard will discuss the significant proposed changes in the income tax laws as they would impact individuals and corporations. Please welcome Howard Backrens.
Thank you, Fred. Good afternoon, ladies and gentlemen. As Fred said, my name is Howard Backrens. I'm the tax director at KRD. Our headquarters is in Schaumburg, and I'm glad to be presenting today. I'm going to be talking about selected tax provisions of the Build Back Better plan that's, as Fred said, had passed in the House and is now currently with the Senate. Part of the I want to start with part of the bill has to do with IRS enforcement and funding for additional IRS expenditures. This bill provides $1.9 billion for the taxpayer advocate, pre-filing assistance and education, and filing and account services. So basically $1.9 billion to help taxpayers. Enforcement, they're going to fund an additional $44.9 billion for collection and determination, criminal investigations, cryptocurrency monitoring, et cetera. Basically audit situations where they're going to put more money into IRS audits. Operations, they're going to fund an additional $27.3 billion for facilities and telecommunications and another 4.88 billion for callback technology and other technology. And as one who deals with the IRS very frequently, I could tell you that they could use some upgrades into their technology. Some of the business tax provisions that are part of the new law probably won't affect anybody here, but it will affect certainly the large corporations, the Amazons of the world, the Teslas of the world, who there's a perceived inequity because they're making very large profits, but they're not really paying income taxes because they have prior year attributes or loss carry forwards or R&D credits that are offsetting their tax in full. So one section of this new proposed law institutes a corporate minimum tax. So if a company has adjusted financial statement income of $1 billion or more over the prior 3 years, there would be a tax at a minimum rate of 15%, and this would begin for tax years after 2021. So I know that probably doesn't affect anybody here. Maybe some private equity individuals would care about this. Another provision in this bill creates an excise tax on the repurchase of corporate stock. I'm sure many of you know companies, when the company pays out a dividend, the shareholders have to pay tax on that dividend. But when the companies often buy back their own stock in the open market, that has a tendency to raise the value of the stock because there's fewer shares outstanding, but that's currently not taxable to the recipients. So basically, this would, for covered companies, domestic corporations that are traded on an established securities market, New York Stock Exchange, NASDAQ, that there would be an excise tax of 1% of the fair market value of the shares repurchased for years starting after 2021. So for example, if a company buys back, $1 billion of its shares, it would pay a $10 million excise tax on that transaction, where before nothing was paid. Some provisions that will affect more people is R&D expenditures. The law is, if this bill didn't pass or doesn't pass starting in 2022, corporations that currently have R&D credits, they carry on activities that create R&D credits. They're also allowed to claim the deduction for the expenses in addition to taking the credit for research and development. Starting under the prior law, starting in 2022, they would have to amortize those costs over a 5-year period instead of deducting them in the current year. This bill defers requirement to amortize until tax years beginning after 2025, and it would require a 5-year amortization for domestic companies and a 15-year amortization for foreign companies. Worthless partnerships are also an area of perceived inequity, because a lot of times if you have a partner, if you invest in a partnership and you sell your partnership interest at a loss, that loss is generally considered capital loss. But if the partnership was worthless, you could abandon it and claim an ordinary loss, which is far better than a capital loss. But under this bill, a loss on a partnership interest that is worthless would be treated as the same as a loss from the sale or exchange of a partnership interest, which generally makes them capital losses as opposed to ordinary losses. And this would begin for years after 2021. Okay, for some of our individual tax provisions, especially for some of our high income individuals, this bill proposes a surcharge on high income individuals, estates, and trusts. So for years beginning after 2021, there would be a 5% surcharge for if modified adjusted gross income exceeds $10 million and lesser amounts for married filing separately, trusts, and estates. There would be an additional 3% surcharge for years after 21 if modified adjusted gross income exceeds 25 million or lesser amounts for married filing separately. One important point I want to make is this is based on modified adjusted gross income, not taxable income. What that means, for an example, if a married couple has a modified adjusted gross income of $15 million, but they make a very generous charitable contribution of $10 million, bringing their taxable income down to $5 million. Well, they would have ordinary income tax rates on the $5 million, but because their modified adjusted gross income of $15 million still exceeds the $10 million, they would have the surcharge on this additional $5 million. This is new, and this will significantly impact high income individuals. It also, as a result of this, will increase the top marginal rate up to 45%. which is the 37% in existing law, plus the 5% and the 3% surcharges for couples whose modified adjusted gross income exceeds $25 million. Actually, that 45% could increase beyond that, and we'll get to that in just a minute. Under the current law, there's a limitation on excess business losses for non-corporate taxpayers. So if individuals have significant non-business income, perhaps portfolio income, capital gains, under the current law created by the Tax Cuts and Jobs Act, business income could only, for a married couple, could only offset $500,000 of that other income, where in the past there was no limitation. This was set to expire in 2026, but this bill would permanently extend the excess business loss rules beyond 2026. It would treat the disallowed amount as an additional deduction carryover. So the loss wouldn't be disallowed, but it would be carried over into a future year. And again, this applies, if this bill is passed, this applies to tax years after 2020. So this will apply to 2021, which throws a little monkey wrench in some of our tax planning, that we've done for 21 for our clients. Another one of the tax provisions is, I'm sure everybody here is familiar that the Tax Cuts and Jobs Act limited the state and local tax deductions as an itemized deduction to $10,000. That's perceived as an inequity, especially in the high tax states. Under this proposal, this would increase it from $10,000. I put here $72,000, but the final bill version had it at $80,000. So if this bill passes, that state and local tax deduction would increase to $80,000. It would still be an itemized deductions, but it would increase. The $10,000 limit would be reinstated in 2031. The limitation would be completely repealed in 2032. And I'm sure many of you know that even if the SALT deduction is increased to $80,000, those taxpayers who have alternative minimum tax won't be able to benefit from that deduction. The child tax credit, again, it basically benefits low to middle income taxpayers. There was an increased credit, basically due to the COVID tax provisions that came out in recent years. That extends the increased credit through 2022 and reduces the advanced credit income thresholds for 2022. The next topic, this one is very interesting too, and very taxpayer unfriendly. I'm sure many of you know that for high income people who have portfolio income or passive income from businesses, in addition to paying ordinary income taxes on their income, also have to pay a 3.8% net investment income tax on that income. So this bill applies that law to all trade or business income and gains from the sale of business assets. So under current law, if your business is an S corporation and you sell the assets of the business, in all likelihood you wouldn't pay it on that. You would not pay it on that sale. Under this provision, you would. And again, I previously mentioned that the top marginal rate would go up to 45% with the surcharges for high income taxpayers. This would increase the top marginal rate to 48.8%, which is the prior 45 plus the 3.8% for taxpayers whose modified adjusted gross income exceeds $25 million. Once again, this applies to all trades or business and gains from the sale of business assets, not just portfolio income and not just passive income. Net operating losses carryovers would not be taken into account as a result of this. Now, this bill, as written, will exclude wages that are subject to FICA and taxes. It will exclude trade or business income subject to self-employment tax, and it applies. You could see if it applies for married filing jointly if your income exceeds $500,000, less so for married filing separately in trusts and estates. In the real world, this is expected to apply mostly to S corporation pass-through income, but less so for partnerships. And the reason for that is because partnerships are often, especially trades or business, partnerships are often subject to self-employment tax on all of their income. So if that's the case, it would not be subject to this because you're already paying self-employment tax on that same income. Limitation on certain rules for Section 1202 As Chris had previously mentioned, 1202 is generally referred to as qualified small business stock. Under the current law, depending on the year you started your business, if you were the original owner and other requirements are met, you could exclude up to 100% of the gain if you sell the stock up to the greater of $10 million or 10 times your basis in the stock. This was a great a planning technique for startup businesses. However, under this bill, if adjusted gross income exceeds $400,000, the 75% and the 100% exclusions will not apply. However, the 50% exclusion will apply for all taxpayers. So you could exclude, if you fall into this category, you could exclude at least half of the gain on that sale of the 1202 stocks. And this, under the bill as written, this applies to sales or exchanges occurring on or after September 13th of 2021, which was the date that this law was proposed. So you have to go back in time for this one. Constructive sales. I'm sure many people are aware with constructive sales. If you hold a position in a highly appreciated asset, there was often an offsetting position that you could take to limit your risk in that asset and avoid selling that asset. Well, since the 90s, if these were marketable securities, that would be treated as a constructive sale, and you would be taxed as if you sold the underlying security, even though you didn't, even though all you did is create an offsetting position. This bill now includes digital assets, cryptocurrencies, and the like as part of this law, and it applies to it will apply to constructive sales after the date of enactment. So if you did a constructive transaction in cryptocurrency, right now, that would be upheld, and you wouldn't have to pay the tax on that. And even though this is the next bullet point, there's new and enhanced digital asset reporting requirements starting in 2023. Right now, cryptocurrency is wide open. People are doing everything they want, and there's really no tracking of it. But starting in 23, there will be enhanced digital asset reporting requirements by brokers, banks, whoever controls it. And even though this is not part of this bill, but this was included in the Infrastructure and Jobs Act that was signed into law back in November. Another modification of the wash sale rule. I'm sure many of you know that if you were to sell a security at a loss and buy it back before 31 days was over, your loss would not be allowed, but your loss would be tacked on at the second purchase. This bill adds commodities, foreign currencies, and digital assets to the list of items that are subject to the wash sale rule, and it applies to tax years after 2021. Interesting enough, some of the provisions that were not included in the bill, which are very notable, is initially they discussed an increase in the top marginal rate to 39.6%, didn't make it in the bill. There was also a discussion to increase the long-term capital gains rate and the qualified dividend rate up to 25%, not included in the bill. Initially, there was talk about changing the income thresholds at which long-term capital gains rates increase from 15 to a maximum of 20%, not in the bill. Another thing discussed was treating transfers by a gift or at death as a deemed sale for certain high-income individuals, not in this bill. And as Chris previously mentioned, there's always discussion of carried interest, which is 1061. Carried interest part was initially, as part of this bill, would have been included as a short-term capital gain and not allowing you to use the preferential tax rates for long-term capital gains. This is not included in the bill. A couple of the Illinois changes that are not really part of the Build Back Better bill, but most of our clients are based in Illinois. I'm sure many of you people are. So one of the things that they changed in Illinois was 100% bonus for depreciation for federal tax purposes will not be allowed for the tax years beginning on December 31st, on or after December 31st, 2021. So there will be Illinois adjustments for 100% bonus depreciation, just like there was, maybe 12 years ago or so, 8 years ago, before they introduced 100% bonus. This second one really relates more to businesses, but businesses that have net operating loss carry forwards, those losses will now be limited to $100,000 per year for years on or after December 31st, 21 and prior to December 31st, 2024. Also, and this one is a big one, and there is a $10,000 SALT cap workaround for partnerships and S corporations. And now there's also now about 17 or 18 states that have passed laws that are going to do this. I'm sure, under the Tax Cuts and Jobs Act, the limit for state and local taxes was $10,000 per year. That included individual income taxes, real estate taxes, and any other taxes. What the IRS came out last year and put out a guidance that said, if the pass-through entity makes an election to deduct the tax, that would be acceptable to the IRS. So many states, including Illinois, California, Minnesota, and maybe 15 or 16 others, have put in new laws starting this year that allow the pass-through entity itself to make an election to deduct and pay the tax and claim a deduction for it against corporate income, and still allow the individual owners of the business to claim that their share of that tax as a credit on their state tax return. This is one of the best, most taxpayer-friendly provisions to come out of the IRS in most recent years, and will basically render the SALT tax limitation for pass-through businesses ineffective. This is a real big one. I think that's all I have on my discussion. So I'm going to pass it off now to I think Jennifer and Alana, and let them go with their segment.
Great. Thanks very much, Howard. That was a great encapsulation of the major income tax changes in the Build Back Better Act for a discussion of the other prong of the act is the retirement changes. And our final two speakers are two of my partners here at Gould & Ratner in Chicago. They'll discuss the potentially profound impact of the changes on retirement accounts, which are 150% of GDP, which astounded me when I read that. My partner, Jennifer Tulsky, has a wealth of expertise in advising businesses, families, individuals in complex estate planning, wealth transfer, succession planning, and the income tax aspects of business transactions. Jennifer also has worked in a prominent public accounting firm. My partner, Alana Bly, also focuses on complex estate planning and wealth transfer strategies. Alana is particularly adept at designing and implementing tax-efficient estate plans and administering trusts. Due to the proposed legislation, estate planning, as impacted by changes in retirement benefit taxation, will provide considerable avenues and opportunities for revised planning and focus. So stay tuned for Jennifer and Alana to tell us all the changes that are afoot.
Thanks, Fred. The tax legislation, which was introduced by the House Ways and Means Committee on September 14th, 2021, included several proposals affecting retirement plans. The Build Back Better Act incorporates many of these proposals, which we will further discuss. There are two new proposed limitations on high-income taxpayers with large retirement account balances. The first of which is a contribution limit, and the second of which is an increase in minimum required distributions. First, we'll discuss the contribution limit for individual retirement plans of high-income taxpayers with large account balances. Under current law, taxpayers may make contributions to IRAs regardless of how much they already have saved in their accounts. The proposed law seeks to prohibit contributions to a traditional or Roth IRA for certain taxpayers if the combined value of the taxpayer's IRA and other retirement accounts exceed $10 million at the end of the previous taxable year. The proposed law would apply to taxpayers whose modified adjusted gross income exceed a certain threshold. For taxpayers who file their tax returns as single or married filing separate, the threshold is $400,000, head of household $425,000, and married filing joint or surviving spouse $450,000. For such taxpayers, to the extent the aggregate vested balance of their IRAs and other retirement accounts, such as qualified defined contribution plans, annuity contracts under Code Section 403B, or governmental eligible deferred compensation plans exceed $10 million, the taxpayer would be precluded from making any additional contributions to their IRA. Rollover contributions and accounts acquired by death, divorce, or separation are not considered additional contributions under this proposal. The $10 million threshold and the modified adjusted gross income threshold are subject to inflation adjustments beginning after 2029. The excess contributions are also subject to an excise tax. The proposed tax law change also creates a new annual reporting requirement. If a retirement account has a vested balance of at least $2,500,000 at the close of the plan year, the plan administrator must file a statement with the IRS, which includes certain information about the plan. The $2,500,000 threshold is subject to inflation adjustments beginning after 2029. The effective date for the proposed tax law change is for taxable years beginning after December 31st, 2028. And this differs from the effective date which was previously proposed, which was for taxable years beginning after December 31st, 2021. The next proposed change regarding retirement plans is the increase in minimum required distributions for high-income taxpayers with large retirement account balances. Like the previous proposal, this affects certain taxpayers whose modified adjusted gross income exceeds certain threshold amounts, which are the same as previously discussed. $400,000 for single or married filing separate, $425,000 for head of household, and $450,000 for married filing joint or a surviving spouse. If, as of the close of the previous calendar year, the combined balances of the taxpayer's IRA, Roth IRA, and certain other retirement accounts exceed $10 million, an excess minimum required distribution is required from such accounts. The excess minimum required distribution is generally 50% of the amount by which the combined account balances exceed $10 million, reduced by any required minimum distributions determined without regard to this new rule. However, if the combined account balances exceed $20 million, then the excess minimum required distribution is calculated by first determining the Roth excess amount, which is the lesser of the amount required to bring the combined balance of all accounts to $20 million, or the balance in any Roth IRA and designated Roth accounts. Once the Roth excess amount has been calculated, the total excess required minimum distribution is determined by summing the Roth excess amount plus 50% of the excess of the combined account balances over $10 million, less any Roth excess amount. If the Roth excess amount is applicable to a taxpayer, the taxpayer must first take distributions from the Roth IRA and then any designated Roth accounts. The taxpayer may determine which accounts the excess minimum required distribution is distributed from, subject to the Roth distribution rules. So, for example, if a taxpayer has a balance of $5 million in a Roth IRA, a combined balance of $20 million in other retirement accounts, for a total combined balance of $25 million, the excess required minimum distribution is $10 million. The Roth excess amount is $5 million. The excess of the combined balances over $10 million is $15 million, which is the $25 million minus $10 million. $15 million less the Roth excess amount is $10 million, 50% of which is $5 million. Thus, $10 million is the excess required minimum distribution. The excess required minimum distribution must first be distributed from the taxpayer's Roth IRA in the amount of $5 million. The remaining $5 million of excess required minimum distributions may be made from the taxpayer's other accounts as the taxpayer determines. If the taxpayer has an account balance in an employee stock ownership plan, any portion of which is invested in employer securities which are not readily tradable on an established securities market, the increase in the required minimum distribution amount is not allocated to such portion. Excess required minimum distributions are not subject to the 10% penalty on early distribution. However, excess required minimum distributions are subject to 35% withholding, and the taxpayer may not elect out of this withholding. The effective date for the proposed tax law change is taxable years beginning after December 31st, 2028. And this differs from the effective date, which was previously proposed, which was for taxable years beginning after December 31st, 2021. Next, I'll hand it over to Alana to discuss the remaining proposed changes to retirement plans, as well as what did not make it into the Build Back Better Act.
Thanks, Jennifer. Continuing our discussion of proposed changes to the rules governing retirement plans. As many of you know, contributions to Roth IRAs are a way to build tax-free savings. These contributions are limited to $6,000 in 2021, and that amount will remain the same in 2022, plus an additional $1,000 if you're 50 years or older. However, high earners are prohibited from contributing directly to a Roth IRA. For this purpose, a high earner in 2021 is a single taxpayer with modified adjusted gross income of $140,000 or a head of household with that amount of modified AGI. That amount goes up to $144,000 in 2022, or a married taxpayer filing jointly with modified AGI of over $208,000, and that'll go up to $214,000 in 2022. Currently, those high earners may be able to contribute indirectly to a Roth IRA using a technique commonly known as a backdoor Roth. This is done by making a non-deductible contribution to a traditional IRA, and then at some time thereafter, converting that contribution to a Roth IRA. Proposed legislation would eliminate this strategy, and a similar strategy currently permitted for employer-sponsored retirement plans, such as 401ks, after December 31st, 2021. There has always been some speculation that the IRS might eliminate this through regulations or rulings, but now here we are with the congressional proposal. If you're thinking of using this technique for 2021, you should, of course, consult with your own tax advisor prior to doing so. Also under the proposal, high income taxpayers would be prohibited from converting any pre-tax savings into a Roth. This rule would apply to conversions of pre-tax contributions to traditional 401ks and pre-tax contributions to traditional IRA. And for purposes of this rule, a high income taxpayer is the same as for purposes of the rules that Jennifer discussed. However, this change is not scheduled to apply until 2032, and who knows what will be the tax rule 10 years from now. We can barely predict what will happen in Congress next week. In terms of other changes applicable to retirement accounts under the proposal also extends the statute of limitations for valuation of investment assets of an IRA and for prohibited transactions from 3 years to 6 years. This change would apply to taxes with respect to which the current 3-year statute of limitations ends after December 31st, 2021. Also, the proposal clarifies that an IRA owner is always a disqualified person with respect to the IRA, effective for transactions occurring after December 31st, 2021. And as background, a disqualified person is someone with whom an IRA is prohibited from engaging in certain transactions, such as borrowing money from the IRA, selling property to the IRA, or using the IRA as security for a loan. A few notable items that are not in the current draft of the Build Back Better Act that I wanted to mention. So the tax legislation proposed by the House Ways and Means Committee in September, which I will refer to as the September proposal, contained a few provisions that were omitted from the current draft of the Build Back Better Act. One of the proposals was to accelerate the expiration date of the double estate and gift tax exemption from December 31st, 2025 to December 31st, 2021. Since this proposal was not included in the Build Back Better Act, hopefully we still have 4 more years to take advantage of the double estate and gift tax exemption, which, as Chris mentioned, is currently $11.7 million per person, increasing to $12.06 million in person in 2022. So an increase of $360,000 per person. Also, the September proposal contained several sweeping changes to the grantor trust rules. It proposed to pull the assets of an irrevocable grantor trust back into the grantor's estate, to generally treat distributions from grantor trusts as gifts, and to end the treatment of a grantor and its grantor trust as one taxpayer. So to treat sales and exchanges between a grantor trust and its owner as taxable transactions. These proposals all got dropped in the current draft of the Build Back Better Act. And so this means that the planning techniques that Chris highlighted, such as the use of GRATs, hopefully won't be going away anytime soon. Third, the September proposal also included changes to our current valuation rules. So today, if there's a transfer of a closely held business interest between related parties, the value of the transferred interest is the same value that would be used if the parties were at arm's length, and for a smaller interest would normally include discounts for lack of control and or lack of marketability. Under the September proposal, in valuing a transferred interest of a closely held business, you would look through the closely held business and generally only discount assets of the entity that are part of the active business of the entity. However, the Build Back Better Act did not retain this proposed change. And finally, neither the September proposal nor the current draft of the Build Back Better Act makes mention of a termination of basis step up upon death. Even though these provisions were not included in the Build Back Better Act that was passed by the House, it's important to remember that there's nothing to prevent these provisions or other provisions from making their way back in during the Senate's consideration of the bill. And now I'll hand it back to Fred.
Good. Well, thanks very much, Alana, Jennifer, for telling us all about these changes in the retirement plans, which means that thanks to Howard's discussion about all the changes of the income tax plans, we won't be able to retire too soon because we're going to be spending more money on taxes. So this concludes the formal portion of the program. We really invite you to, we've got 4 incredibly gifted and experienced experts on planning, taxation, M&A, retirement plans, estate plans, income tax plans right at your disposal. So encourage you to ask questions. Just send me an email, or chat room is open. Let me ask you, Alana, you mentioned that who knows what's going to happen in Congress next week, right? But what is happening, you know, in the Senate with respect to the retirement or the income tax side? We read in the paper and you know, in the popular press about all the ways they're going to spend all this money that's being raised through increasing tax rates. But have we seen any pushback in the Senate on either the income tax side that Howard mentioned or the retirement benefit side that Jennifer and Alana mentioned? Does anybody know where things stand?
I have not seen one way or the other. I'm not sure if anyone else can shed light.
No, there's been no news as to how this is progressing in the Senate.
Okay, well, assuming this passes as it is, and we know the Senate never makes any changes in House legislation, but assuming you know, this changes, if you had is there anything you would do like this year I'll start with you, Howard, on the income tax side. Jennifer and Alana, maybe you have one thing you would advise people doing on the retirement side, and Chris, you're the jack of all trades, so you on, you know, how would you answer that as well? So maybe start with Howard.
Okay, well, even though not particularly part of this bill, but the you know, the IRS guidance on pass-through entities making this you know, basically making the election to deduct the shareholder tax at the entity level is a very, very taxpayer-friendly ruling. And the states, like I said, there's Illinois, California, Minnesota, and maybe a total of 16 or 17 states that have adopted plans that meet the IRS's requirements. It's really big for businesses that are pass-through entities. As an example, you know, in Illinois, the tax rate is roughly 5%. So if there's a business that has $1 million of pass-through income, Basically, it would pass that income down to the shareholder, and the shareholder would pay personal tax on $1 million and not be able to deduct that tax because it's the state and local tax. Now, under this ruling, the company could basically pay the $50,000, 5% of $1 million, could pay that $50,000, deduct it at the entity level. So instead of $1 million of income passing through to the owner, it would only be $950,000. And the owner could still claim that $50,000, their share of that payment, on their personal return as an offset to the income. So this is a real winning situation, and I would advise all pass-through entities, owners of pass-through entities, to take advantage of this. The way I read the law, the payment would have to actually be made, even for accrual basis taxpayers, of which most businesses are, unless they're service businesses. The way I read the law is that actual payment would have to be made in the calendar year 2021 to apply for 2021. That's the way the IRS guidance seems to read. There's been no further guidance to whether or not that's true. So I would say to guarantee that this deduction will work, you might want to consider doing this in 2021, making this payment, and then claiming the tax benefits from it.
Good. Chris or Alana, Jen, on if you had one thing, one planning opportunity this year, assuming that the House bill becomes law, is there anything that jumps out at you that you would do to, for your clients?
I think for, I know this is not on the retirement side necessarily, but we know that the exemption is going to go down. It may not be going down tomorrow, but we know we have a few years left. So I think for those clients who are able to utilize their exemptions, I would advise them to do so, because, this is something that we know that's going to happen in the future.
Yeah, good. Okay. Thank you. There's a question from Bill Coleman, unless Chris, you've got anything to add.
I was just going to add, the two things I was going to add would be the exemption. So I totally agree with Jennifer on that, because especially if you have benefited from some kind of, wealth event in 2021, even if it's just merely stock market appreciation, and you have that excess wealth, the capacity to consider shifting, take advantage of that. Along those lines, on the charitable front, I would also add that, even with the recent market turbulence, we're at kind of historic highs in terms of the equity markets. So harvesting some gains and then locking in that charitable income tax deduction in a vehicle like a donor advised fund to use against income and potentially carry forward for 5 years is certainly a very easy tactic to do before now and year end. And then that can pre-fund future years of giving. So I'd maybe add that as well.
Good. Thank you. There's a question from Bill Coleman, who asks, given the pending law as it affects capital gains. So this is probably more of a Howard question, even though I could see maybe it's a Jennifer and Lana question, and also Chris. But given the possible change in the capital gains, what's your advice for individuals who are long-term investors and who are sitting on massive unrealized gains?
Well, obviously, you would want to consider maybe realizing some of those gains and paying the taxes at the 20% today that you know that you're going to pay versus 25% tomorrow. And also, you have to consider, the company, do you want to, if you're going to, you have to consider, the stock market, what the future holds for the stock market. Nobody knows. But clearly, if you're concerned about raising tax rates, capital gains tax rates in the future, it may be time to accelerate or realize some of those gains in the current year, pay your 20% federal tax, and redeploy that wealth into another investment. It's tough to know. For example, the Build Back Better bill does not include a capital gains rates increase, but sooner or later, that rate, it will increase. Particularly if the Democrats retain the House in 2022. So it may be time to consider maybe realizing some of your gains paying the tax and moving on to the next investment.
Okay, great, thanks. This is probably a question for Howard. You talked earlier about the amount of money allocated to IRS enforcement. I've been hearing about that forever. You know, and that is a panacea, and all, you know, as if this were a third world country and everyone is, not paying their taxes when they should, or the amount that they should. So how realistic is this in your mind? If you had a crystal ball, how realistic is that the allocation to the IRS? How much money is really going to be, filtered out as and saved or accumulated that would not have ordinarily been, raised as a result of these enforcement provisions?
Well, I think these amounts will eventually be funded. I believe this bill, if the bill passes, these will be the amounts. Maybe they'll be shaved off a little bit, but I believe that the current administration considers IRS auditing enforcement a priority, because there is a large tax gap out there currently. Either intentionally or unintentionally, errors on tax returns. There's a big tax gap out there, and I think that the current administration is focused on closing that gap. So I think that it's a priority to fund increase IRS budget in order to allow for more audits and to basically close that tax gap. So I think it's a pretty likely scenario that this amount or amounts close to this, if the bill passes, will increase funding with the IRS for the IRS.
Do you get a bounty? Do you get a percentage for everything that they raise?
Well, strictly speaking, yes. If you have reason to know somebody's cheating and you actually turn them in, you can actually collect some money from the IRS. I'm not recommending that people do that, but there is a way there is a mechanism for collecting if you inform the IRS as to, like, for example, if you're an employee and your company's is fudging things, there are bounties to be had.
It sounds almost like the Texas abortion law. So, but we won't go down that path. This is a question. It's probably for Jennifer and Alana from Greg Gochek, and that's: could you discuss how to implement qualified longevity annuity contracts, and maybe also for Chris, to reduce required minimum distributions from IRAs? So how to implement qualified longevity annuity contracts to reduce required minimum distributions from IRAs. I know I can't answer the question.
Yeah, I don't think Jennifer and I, unfortunately, we're not experts, and I personally I'm not familiar with how that might work.
Okay, no problem. Don't want to put anybody on the spot. Chris, is that something? I thought there was a bullet in your slides about these contracts, or am I mistaken?
In my slides, Fred?
Maybe I'm mistaken.
No,
so.
yeah, that's also not an area I would consider myself with expertise. I do think that if you have large IRAs, one of the areas that you may want to consider in lower AGI years would be partial Roth conversions to reduce the overall size, because Roths aren't subject to RMDs, required minimum distributions, but I'm not familiar with the nuances of the annuity techniques that I think are being asked there.
Yeah.
And I think that if the annuity, it's possible that annuity, at least for purposes of these new provisions, would be included in the calculations of determining the excess required minimum distribution amounts, right? So it would have to determine what those plan terms look like.
Let me ask a question of probably of Chris. Seems like from a fund perspective, from a private equity fund or a venture capital fund, real estate fund perspective, dodged a bullet in terms of like the cash not going to 5 years. It sounds like they did not dodge a bullet in terms of the 1202, the qualified small business exemption. Sounds like that was kind of a hit, and then some of the other income tax provisions hurt everybody. So is that how you look at it? Or if you're a fund person, you're an investor in a fund, does this change your risk appetite or your return threshold, you know, that you seek?
I would think that the one of the primary drivers of the things you mentioned would be the tax character of the carry. So for that to still enjoy favorable 20% long-term cap gains rate levels relative to ordinary income tax treatment, as long as you maintain that holding period, I would think that that's probably the most important one. QSBS Section 1202 applying is more, I would say, limited versus universal. For certain companies, there's some industry requirements for fit and qualification there as well. So I think the biggest takeaway is the carried interest tax character, from my perspective, is still enjoying that long-term rate. But I would also lean on Howard for his perspective too.
Yeah, I agree. I think that it is a benefit that has not been you know, changed under this bill. But I do know that's been a hot topic for both parties in the government. So I think that eventually they're going to do something with long-term carried interest. I mean, they did something a few years ago, making it instead of 1 year, you had to hold it 3 years to get the preferential 20% rates. I still see that as on the chopping block. I know that's not what the private equity people want to hear, but I think long-term or maybe middle term, that's on the chopping block, and there could be significant reductions in the benefits for carried interest. I think that's one of the things coming next.
So Sherwin Brook is asking, probably this may be a Jennifer and Alana question, but it may not be, and Howard and Chris are probably able to jump in too, but let me just throw this out. And he asks that since most people we deal with do not have a net worth of greater than 10 million, what suggestions would you have for higher income taxpayers with estates of less than $10 million?
I mean,
Go ahead, Alana.
I would echo again what Jennifer was saying before. I would still encourage them to use their exemption because the exemption will be going back down to 5 million adjusted for inflation. So, you know, I would still encourage that.
Good. Anybody else? Well, good. This has been a great discussion and a great panel. Thank you all for attending. Really appreciate it.